In the last episode, we explained that to understand why most people never achieve financial freedom, we first need to see how banks quietly multiply your deposits through a system that relies entirely on trust, because without it, the whole thing would collapse. Today we go deeper. But first, let Ian explain how he discovered the hidden engine behind modern banking, fractional reserve banking. On the surface it seems simple, but behind the scenes it operates as a massive, globally powerful system of hidden leverage, one that can collapse the moment trust disappears. In this episode, we'll reveal how everyday deposits become enormous leverage, why central banks allow it, how it fuels boom and bust cycles, and most importantly, what you can do to ride these cycles toward your ultimate financial freedom.
My name is Ian. I am a partner at BFRCONSULT, who sponsors these videos. In 2009, a good friend of mine lost a fortune in UK property investments. His job disappeared and his personal life was in turmoil. I knew him as a very cautious person, but sometimes people simply don't know what they don't know. Back then, property investment companies were still advertising like there was no tomorrow, insisting that prices would only go up. At the same time, my friend told me that a banker casually confided in him that a crash was coming in 2007. In those circumstances, which voice do you trust, the property investment companies or the casual banker? The UK property crash began in 2007 and accelerated throughout 2008 and 2009 as the global financial system spiraled into crisis. During numerous discussions with my friend, he kept asking himself, why didn't he see this coming? That question sent both of us down a rabbit hole. Using a mastermind approach, we read, we watched, and we pieced together how the system really works. That's when we stumbled upon fractional reserve banking, the reality that banks don't hold all deposits, but lend out the majority while keeping only a small fraction in reserve. Suddenly, everything made sense. The credit crunch of 2007 wasn't just bad loans. It was a crisis of trust in a system built on confidence and leverage. Once that confidence was shaken, even a small doubt could freeze the entire mechanism. Exactly what happened, paving the way for the 2008 global financial crisis. By 2012, the scale of systemic risk had become undeniable. In the US, government debt was more than 14 trillion, and unfunded liabilities were estimated at over 113 trillion. But the danger wasn't just in America. In the UK, public sector debt had surged to around 1.35 trillion. That's roughly 81% of GDP at the time. Across the Eurozone, the problem was just as big. By mid-2012, government debt had reached about 90% of GDP in the Euro area countries. The system was leveraged dangerously, invisibly, and most people didn't even realize how precarious it was. Seeing this breakdown of trust between banks, even with central banks watching, pushed me to dig deeper. How was money really created and managed from a single bank to an entire network? This became the foundation of my search for financial protection against a system that could collapse in an instant. A system that works for a select few, those who understand it, those close to the levers of money creation, while leaving most people exposed.
Welcome back. This is episode 4 of our 10-part series, Your Money in the Bank Isn't Yours. The Hidden Leverage. If you missed episodes 1 to 3, don't worry. The links are in the description, or they might be popping up on the screen right now. Watching them will give you extra context, but you can dive into this episode without any problem. Here's the deal. The more engagement these videos get, the faster we can release the rest of the series. Every like, share, and comment helps us move forward. And of course, with each episode, we reveal one of the 10 essential books that shaped our approach to financial independence. These aren't just theory, they're frameworks used by people who actually built wealth in the real world. In episode 3, our book pick was Cash Flow Quadrant by Robert Kiyosaki, a game-changing guide that shows why most people work for money, while a select few make money work for them. It explains the mindset shift from employee or self-employed to investor or business owner, the very shift that allows you to escape the financial rat race. We'll reveal this episode's book pick toward the end of the video. By the time the series wraps up, you'll have the full reading list, your personal roadmap to the most actionable ideas ever written about money and independence. So hit subscribe and let's dive in.
In episode 1, we exposed the money trap. The money in your bank isn't truly yours. Banks can decline payments even when your account shows a balance. In episode 2, we dug into the fine print, the hidden clauses that let banks use your money as their own. Legally, you aren't a customer, you're a creditor, someone who has effectively lent their money to the bank. The number you see in your bank app isn't a pile of cash in a vault, it's a promise, the bank's liability to you. When you deposit money, you're lending it to the bank. And that liability, the bank can use it to make loans, multiplying your deposit across the system in ways most people never see. This principle is recognized worldwide. Deposits belong to the bank and customers hold only a claim, not the actual cash. But it's not just the banks you need to understand. Episode 3 showed how governments and regulators hold a hidden spare key to your accounts. Broad legal powers to freeze, limit, or seize funds under circumstances you may never expect. Understanding the engine behind your money is critical. It reveals where the real risks lie and where you can take action to protect yourself. In this episode, we'll show exactly how banks take your deposits and transform them into enormous leverage. A system that fuels booms, triggers busts, and creates opportunities for those who truly understand it. Let's find out more from Ian.
There is a money multiplier that you never see. When a bank issues a loan, it isn't taking money from another customer's savings, and it isn't moving funds from its own vault. Instead, it creates a matching deposit, brand new money, with a few keystrokes. That new deposit is then spent, redeposited into the same bank or another bank, and used to support even more lending. The cycle continues across the entire banking system. Older textbooks describe this mechanism using the term fractional reserve banking, the idea that banks kept 10% in reserve and lent out the remaining 90%. But in modern economies, those reserve requirements no longer apply. Banks are not constrained by a fixed reserve ratio. Instead, they are constrained by regulation, capital requirements, risk limits, and the quality of their assets. Yet, the outcome is the same. One loan can ripple outward and multiply into many deposits across the economy. This is why some experts say that money is debt. Every pound or dollar created by a bank is someone's liability, money that exists only because a loan was made and because the system assumes that loan will be repaid. Most of the money we use isn't physical cash, it's bank-created credit, numbers on a screen produced every time a bank extends a loan. In the modern financial system, broad money isn't printed. It's created at the moment a bank makes a loan. So, rather than calling today's system fractional reserve banking, a more accurate term is credit creation banking. Why? Because in modern economies, banks are no longer constrained by traditional reserve ratios. In the United States, reserve requirement has been 0% since March 2020. In the United Kingdom, no mandatory reserve requirement for commercial banks. In the Eurozone, a 1% reserve requirement, but it does not meaningfully limit bank lending. Therefore, in practice, a bank's ability to create new money by issuing loans is no longer constrained by reserves. Instead, it is limited by capital rules, liquidity rules, and risk management frameworks, not by the fraction of deposits the bank must hold. Remember that broad money isn't printed. It's created when banks make loans out of thin air. The problem with the credit creation banking system is twofold. First, it works like a high-stakes game of musical chairs. There are always fewer chairs than players, meaning there's never enough cash on hand if everyone tries to withdraw at once. As long as the music plays, confidence is high and only a few people need their money at the same time. The system works. The economy hums, businesses grow, and banks earn profits. But if the music stops suddenly, rumors spread, markets panic, or a bank looks unstable, everyone rushes for a chair. The problem? There aren't enough chairs. The bank only holds a fraction of the deposits it owes, or in extreme cases, almost nothing at all. That's when bank runs happen. Second, there is never enough money in the system to cover all the interest that accrues on loans created out of thin air. For the system to function, debt must constantly expand. Without continuous borrowing and lending, the music stops and the game collapses, because although credit creation banking is powerful, it is also fragile. The key is understanding this game, how deposits, loans, and interest interact, so you can navigate it safely and take steps to protect your wealth.
There is a thought widely attributed to Sir Josiah Stamp, a leading British economist, statistician, and former director of the Bank of England. Nearly a century ago, he reportedly warned about the immense power behind modern banking. Banking was conceived in iniquity and born in sin. The bankers own the earth. Take it away from them, but leave them the power to create deposits, and with the flick of a pen, they will create enough deposits to buy it back again. However, take it away from them, and all the great fortunes like mine will disappear, and they ought to disappear, for this would be a happier and better world to live in. But if you wish to remain the slaves of the bankers and pay the cost of your own slavery, then let bankers continue to create deposits. This is a stark reminder that understanding money isn't optional. It is the foundation of freedom. Because once you truly grasp the game, how deposits, loans, and interest actually work, you stop being an uninformed victim, a passive participant swept along by the system, and you begin searching for a way out, just like the members of our community. Only then can you navigate this world more safely and take real steps to build, protect, and grow your wealth. Ian continues with his reflection.
Reflecting on fractional reserve banking, which I've decided to call credit creation banking instead, because it makes the system plain, real, and far less mystical. I believe this is one of the most powerful forces in the modern world. Because in many ways, that force resembles financial nuclear energy, extraordinarily productive when stable, but dangerously destructive when mismanaged. On one side, it undeniably fuels economic growth, enables home ownership, finances businesses, and keeps the wheels of the economy turning. But on the other side, the very same mechanism can contract credit, freeze activity, bring entire industries to a halt within months, and, most tragically, cause people to lose their jobs, their homes, their assets, or their livelihoods. And because every new unit of money is born as debt, the system depends on an ever-expanding cycle of borrowing simply to stay alive. This creates a structure where the real economy, workers, families, and small businesses must continually feed a monster, the global debt that can never fully be paid off. That's the hidden leverage architecture behind what many experience as the rat race. It forces humans to exchange their life energy for pounds, dollars, euros, or other currencies that are created as debt. A debt system that is fundamentally designed to compound and therefore grow faster than the income generated by most labor. A global financial architecture that quietly imposes something most people feel but rarely understand: why your savings earn almost nothing, often less than inflation. While your money sits in the bank is using it to generate returns for itself. You get a sliver. They get the leverage. And in moments of financial stress, this system leaves depositors far more exposed than they realize. This is why voices like Robert Kiyosaki, Ray Dalio, and other financial thinkers keep repeating the same warning. Cash in a bank may feel safe, but it was never designed to grow your wealth. And in extreme scenarios, when confidence cracks, your deposits may be more vulnerable than you think. Understanding this system isn't about fear, it's about clarity. It's the first step toward taking control of your financial future, instead of outsourcing it to a system built on leverage, debt, and trust that can evaporate overnight. But as you'll soon see, when confidence truly breaks, there's a second danger, one almost nobody is taught about until it's too late. A danger not from a bank collapsing, but from the bank staying open. A danger hidden in plain sight inside modern banking law. A danger with a name: bank bail-ins.
When banks failed in 2008, governments rushed in with massive taxpayer-funded bailouts. Depositors were protected and banks survived. On paper, no one lost their savings, but critics warned of the price. Private losses were socialized, public debt exploded, inflation simmered. However, beneath the surface, a new doctrine emerged, one that quietly changed who takes the hit next time. Today, many experts argue your bank account is at greater risk than ever, not from collapse, but from value destruction. In the next episode, we'll explore how modern bail-in laws work, why they were created, and why ordinary savers have never been more exposed. And now, as promised, this episode's book recommendation is Your Money or Your Life by Vicki and Joe Dominguez. The book asks the question most people avoid: what are you truly exchanging your life for? In a system where money is created as debt, controlled by institutions and quietly eroded by inflation, that question matters more than ever. The book lays out a 9-step program that helps you rethink your entire relationship with money. It teaches you to track where your money goes, calculate what it really costs you in hours of life, and align your spending with what genuinely brings meaning and fulfillment. At its core, it's a guide to reaching the point where your investments, not your labor, pay for your life, and where you reclaim your time, your most precious asset. If this episode made you rethink what money really is, hit subscribe and share it with someone you trust. In the next episode, we'll reveal concrete ways to step outside the illusion of safety the system sells.